If you tell me that 3% long bonds will prevail over the next 30 years, stocks are incredibly cheap.
Okay.
Because even, I mentioned that Kraft Heinz earns $6 billion on $7 billion of tangible assets. Even if you pay $70 billion and you earn $6 billion on it, that's better than having $70 billion out in 3% government. Interest rates govern everything. And if there were a way to short 30-year bonds and own the S&P for 30 years, I would give you enormous odds that the S&P is going to beat 30-year bonds. Now, we've had this period of extended long-term low rates, not only here, but around the world, and now it looks like we're not going to jack them up very fast. So we may be in a new world, the world that Japan entered back in 1990, and if so, stocks will, when we look back on it, will look very cheap. But, this has not been the history of the United States to have these continued low interest rates. So if I had a choice today for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Well, that brings us to a question that a viewer wrote in. This is T67. Piyush Pant says, from the annual report in the 13F, it looks like Berkshire was the least active in the public markets in the quarter when the stocks were the cheapest. You also did fewer buybacks in the fourth quarter when Berkshire was cheaper. Was taking the foot off the gas in the fourth quarter a conscious decision? And based on what you just said, we got all these signs that look like the Fed was not going to be raising rates in the fourth quarter, too. So why wasn't that a buy signal for you?
Well, I thought stocks were a buy in the fourth quarter, just like they did in the third and second and first quarter. But sometimes we have other things in mind, too, that may use a lot of money, and sometimes they work out and sometimes they don't. But
what does that mean? You were holding your cash in case a deal came through?
We had at least one deal possibly that would have been very large. And so I liked stocks in the fourth quarter, but I would like buying a business even better.
Is that deal?
And incidentally, I did say in the annual report that we expect to be net buyers of stocks in this year. We have not been net buyers, I should point out. I mean, the market's gone pretty much straight up. I still think stocks are more attractive, but I have trouble buying it when every day it's up.
Okay, guys, let's talk about leveraged ETFs. That's leveraged exchange traded funds. Okay, so folks have said that it's possible you lever up your return. So for example, rather than getting 10%, you can invest in a leveraged ETF and get 30%. You can triple your return literally. All right, and that's a statement of fact. If you invest in the S&P 500 and you get 2%, and you invest in an ETF like TQQQ, all right, you could get 6%. That's 3 times whatever you get on the ordinary index. Similarly, if you want to streamline yourself to financial services, if you invest in the FAS ETF, you could get triple the return or thereabout of what you could get investing in just a regular ETF. But the problem is this, guys. The same way you could magnify your gains, you could also magnify your losses, and it's usually very steep. So this video is just to give you a sense check in case you're thinking of going into leveraged ETFs for the benefits. You also need to be aware of the negatives. I invested once in the volatility ETF UVXY, and I made some good money. I made quite some huge gains because it popped up 18%, and I was very happy. And so that made me invest much more in that. And guess what happened? You go check the charts of UVXY, all right? I lost nearly double the gain I made on that particular, fund ETF. Now, I'm not saying that there are not experts that can maneuver their way around this. Of course, you have the people that can always make their way around it. They know when to jump in, they know when to jump out. But the truth is this, guys, if you're an investor, you want to have your peace of mind, you want to sleep well at night, you want to just focus on, the movie when you're watching the movies and not calculate, what's going on while you're watching the movies. You want to just play with your kids without thinking, hey, what's going to happen to our family finance? You want to be very careful with leveraged ETFs. Can you make money with them? Absolutely. Have I made money with them? Yes, I have. Will I recommend them to beginner investors or investors starting out? Not necessarily, by the way. These are personal opinions. I'm in no position to recommend anything to you, but I'm just saying, be careful, guys. And one last thing before I drop off this very quick video. If you have the conviction that a certain sector is going to pull back, for example, if I feel that the semiconductor sector is going to pull back, then I could invest in an inverse leverage ETF in that sector to make money while the stocks in that sector goes down. But then again, guys, I'm just giving examples right here on the ways you can use these ETFs. But be careful, guys. Do not jump into leverage ETFs because you see videos saying, hey, magnify your return, hey, this and that. When they gain, they tell you. When they lose, they don't. So be careful. It's your money, it's your decision, it's your finances, it's your future. So that's about all I got for you in this very quick video. As always, special thanks to all my subscribers and you, my viewers, that are yet to subscribe. Thank you so much, and hopefully I'll see you all again in the next video.